Good morning, everyone. Today we are here for a webinar, which is for UA transfer pricing, corporate tax, and e-invoicing in collaboration with Fame Advisory. We'll start the webinar. We'll wait for another 2 to 3 minutes for more people to join, so we can then proceed with our speakers to go ahead and start the webinar. Okay, so we'll start now. Again, welcome everyone to this webinar, which will give you a brief idea on UAE transfer pricing, corporate tax, e-invoicing. This is all in collaboration with Fame Advisory. So let me introduce you to our speakers for today. So we have Udit Chokshi, which is an associate director compliance with Fame Advisory with over 11 years experience, and leads a team of 11 professional and is recognized for his strong leadership, analytical expertise, and commitment to delivering high quality compliance solution. He also oversees more than 40 VAT returns each month while driving operational excellence, mentoring the team, contributing significantly to the firm's compliance and training initiatives. Then we have our second speaker, who is CA Junaid Halai. He's an experienced corporate tax professional at Fame, providing strategic tax advisory, planning, and compliance support to domestic and international clients across UAE and GCC region. Let me hand over this now to Udit to take it forward from here and give more information on the taxing. As well as I'll just give a reminder here that we have our Q&A tab open for all the questions you would like to raise. Please put it on Q&A tab. Do not put it on chat, because not all the chat can be read immediately. So I would rather suggest put it on Q&A. If time permits, as is a time-bound event, we will take the Q&As and we will discuss with Udit and Junaid. In case if there are any questions missed out, please send it to us through email, or you can directly reach out to them once they share their details. So Udit, you can take it from here.
Thank you very much, Donald, and good morning, everyone. And thank you for sparing time on this educational session, which is a very important and a talk of a town called e-invoicing. I hope my screen is visible. Is my screen visible to all?
Yes, Udit.
Perfect. Great. So I'll start with introduction of e-invoicing. Then we will run through the scope of e-invoicing, key benefits, that how it is going to benefit all of us, implementation timelines and phases, compliance and framework, special scenarios, and business impact. Let's understand first what is e-invoicing. So e-invoicing is a digital version of traditional invoices in UAE. Till now, we all are used to we started with raising invoices manually, then we shifted to softwares, printing the invoices and emailing to the clients. And now we are going one step ahead of e-invoicing, where each and every invoice which you are raising, that will be transmitted through e-invoicing system, right? Now, e-invoicing requirements apply not only to the taxable persons, but all those businesses operating in UAE, regardless whether they are VAT registered or not. Very important point again. Now, e-invoicing is applicable to which documents? To make it more simplified, for all our invoices, whether no matter what is the tax, whether it is a taxable supply or not, e-invoicing is still applicable. And our credit notes, right? So a small overview on the definitions. What is an electronic invoice? An invoice issued, transmitted, and received in a structured electronic format that enables automatic and electronic processing, right? And same way, what is credit notes? The recipient of commodities is responsible for calculating the tax on the value of the supplied commodities and for all the tax liabilities arising from such supply, including the calculating the due tax. Now, let's understand the scope of e-invoicing. E-invoicing is applicable only on these two transactions currently, which is B2B and B2G. Now, what is B2B? B2B means all the business-to-business transactions which you are doing it. No matter if your customers or your suppliers are registered under VAT or not, they are still required to do e-invoicing under B2B. Same way, B2G. So even business to business and business to government transactions, if you are dealing with any of the government where you are doing a sales to them or you're raising invoicing to the government departments, you are required to do e-invoicing. Now let's understand what are the exclusions, which is very limited, but we still need to know. All of our B2C transactions, a business transactions conducted between a person carrying on business and a recipient who is a natural person, not carrying on a business. So that means all the retail transactions where B2C and end consumer transactions are excluded currently. We are expecting that to be implemented in the next phase. International passenger transportation services provided by an airline via an aircraft, that is been excluded, where an electronic ticket is issued to the passenger. Also, it includes the ancillary services. International transportation of goods provided by an airline, those services are also excluded, but that is only for the first 24 months. Financial services that are zero rated or exempt under UAE VAT are currently excluded from e-invoicing. Any business transactions conducted by government entities in a sovereign capacity, that is also excluded currently. Now let's understand the key benefits. As we are aware that UAE's economy or government is moving towards smart economy vision, and that is one of the main reasons why e-invoicing has been introduced, where we encourage modern tech-driven business practices, connects businesses and government digitally, improving accuracy and timeliness in VAT reporting. Currently, what happens is there are a lot of businesses who does VAT return but not accurately, who files the VAT return maybe on time, maybe not on time. So all this will come down, all these errors will come down. So it helps government to take informed decisions. Reducing paperwork and administrative burdens, less need of printing and storing paper invoicing, saves times and efforts on manual tasks, easy to share and track, and secure, reliable, right? The next one is preparing the groundwork for AI, blockchain, and advanced analytics in tax administration. So by this, tax authority will have a clear visibility on the transactions which you are doing, and that will help them to analyze the data. That will also help them to understand that what kind of transactions you are doing it. That may also help you and them in a way where to streamline your internal processes, to streamline the way you have taken the tax stance. Aligns with global standards, yes. Currently, more than 50 plus countries are already a part of global e-invoicing, and now UAE is moving forward to that. And another lot of few GCC countries are introducing next year or two. Oman is introducing this year and next year. Right. So though Saudi has already introduced before 3 years or 4 years, and same way all other GCC countries and a part of UK, Europe also are planning to introduce in next 4 to 5 years. So you will see all these businesses or all these countries implementing e-invoicing very soon. All right, let's understand the implementation timelines. There is a pilot program where ministry will be inviting or has already invited certain taxpayers, and for them they have to go live by 1st of July 2026, which is the first phase or pilot phase. Then it comes and they have to go live by 1st of July 2026. That means currently they are already live on e-invoice. Number two, the phase two or the phase one in a way, if you say, because that's a pilot phase, the phase one is all the customers or all the taxpayers having a yearly turnover of more than 50 million in the previous year, which is 2025. They have to appoint an ASP by 30th October 2026, and they have to go live by 1st of January 2027. That is a phase one. So we have to go back, look at your P&L, look at your turnover, which you have disclosed or which you have in 2025. And let's understand that what is your phases or when you have to start implementing the invoicing. Phase two will be each and every business who has less than 50 million turnover. If you are doing a business of 100,000, 100 dirhams or 49 million, you are still required to register for phase two. You have to appoint an ASP by 31st March 27 and implement or go live from 1st of July 2027. The last phase is for government entities. All the government entities has to register or appoint an ASP by March 27 and go live by 1st of October 2027. Perfect. Let's understand the e-invoicing framework now. What are we achieving? Or what is e-invoicing? So UAE has implemented a decentralized continuous transaction control and exchange model, right? Which basically gives a modern approach to electronic e-invoicing that leverages decentralized technologies to enhance. It also gives an efficiency in streamlining the transactions, processing and reducing the administrative burdens. It also gives you the security in strengthening the data protection and fraud prevention. It also gives transparency, ensuring real-time visibility and compliance with regular requirements. Now, let's understand how the e-invoicing is going to flow, or what is let's assume we are at supplier one. So we are suppliers. So we are sitting at corner number one. The moment we raise the tax invoice or an invoice in our ERP systems, that will go to your corner number 2. Who is your corner number 2? Your appointed ASPs. This corner number 2 will give your invoicing in a transmitted data format to corner number 5, who is Ministry of Finance and Federal Tax Authority. And then upon validation, this data will also be given to corner number 3 at your who is your customer's ASP. So in that case, your customer's ASP will receive this information and will be given to your customer at corner number 4. So by this, what will happen is, the moment you save the invoice in your ERP, the same information within few microseconds will be going to corner number 2, who is your ASP. They will be validating every information which is required by tax authority. I will come in the next slides. You will see that which informations is compulsory and which informations are required to be validated. And then corner number 2 will send the information to corner number 5, 3, and corner number 4. That means, look at it from that angle, where you will start receiving, if you are at other angle, that you are at a buyer, right? So if you are at a buyer angle, you will start receiving the invoicing from your suppliers in your ERP straight away, right? So that means your suppliers, whatever your suppliers share the invoices, that particular invoice you will be able to see in your ERPs as a notifications. That, for example, Fame Advisory has raised an invoice to you. So you will see a notification in your ERPs stating that you have received an invoice from a Fame Advisory. Right? So if you look at it that way, gone are those days where you will have to still print the invoices, sign stamps, scan, and send it to your customers and suppliers. Now, accredited service providers. So tax authority has accredited 42 service providers. Who is accredited means that they have approved these 42 service providers, and these 42 service providers only can become your ASPs. And then only you will be able to start transmitting the data from your ERP to the tax authority. So these are the list of all the 42 approved ASPs. Tax authorities are still adding few more. So we are expecting by October, we should at least have 50 to 55 approved ASPs. Now let's understand what are the minimum fields requirement on your tax invoice, on your commercial invoice, and on your tax credit note. So as you can see on the screen, there are 51 mandatory fields which has been identified by the tax authority, which needs to be there mandatorily on your tax invoice, out of which, under the current tax invoice format which you might be using, it does not have 15 fields, and we have highlighted those here. These 15 fields are not currently available on your tax invoice format. So that needs to be implemented, right? Then let's see the commercial invoices. If anyone is doing high sea sales, port to port sales, free designated zone to designated zone sales, all these transactions will require commercial invoices. For that also, and that also a part of e-invoicing. That means 49 mandatory fields for commercial e-invoice, out of which 16 highlighted fields are mandatory. Let me highlight that 16 fields. So these are the 16 fields which is mandatory under commercial e-invoice. Next, tax credit notes. So tax credit notes or credit notes will also have 50 mandatory fields, out of which 13 fields are not currently available on your credit notes. Now, tax authority has also issued a human readable format of a new tax invoice after you implement all these 51 fields. This is how it is going to look like, where you have multiple new fields which you can see on the invoice. Now, what is this use cases? Tax authority has also identified 16 use cases on which this e-invoicing will be applicable. That means if you are doing any such transactions on that will be covered under e-invoicing. So let's start. UAE standard tax invoice, where you are charging 5% VAT or 0% VAT. Yes, e-invoicing is applicable. Supply under reverse charge mechanism, where VAT liability is shifted to the recipient who accounts for VAT for and pays VAT instead of the supplier. So there also e-invoicing is applicable. As I said, zero rated supplies. If you have a zero rated local supplies, that also, which is example, exports, certain healthcare and education services, there also e-invoicing is applicable. Deemed supplies, goods or services treated as supplied for VAT purposes, even without receiving actual considerations. So we'll take up few examples regarding this in the future slides, but that is also important, and this is one of the important perspective where we are missing out when we do the tax treatments on our regular day-to-day life, right? Then there's disclosed agent billing, summary tax invoice, continuous supplies, supply involving free trade zones, supply through e-commerce, exports, profit margin scheme, standard tax credit notes, disclosed agent billing tax credit notes, commercial invoice, again, non-tax invoice used mainly for customs or trade purposes, not for VAT accounting, self-billing and self-billing tax credit. So these are the 16 use cases which has been identified, and on all these cases, e-invoicing is applicable. Right. So currently we have two unique numbers which we normally use in our day-to-day tax life, or which is one is VAT number, which has a 15 digit, starts with 1, ends with 3, right? Then we have a corporate tax registration number, which again has a 15 unique digit numbers. And now there is something called PayPal ID, which you can see in front of your screen, right? So every license holder, when I say trade license holder, will be required to register and get this particular PayPal ID through which the whole e-invoicing model is going to work. It is as good as this is a new identity given to your trade license, and every supplier or customer who will be sending you there, or you will be sending to your invoices, or your supplier sending invoices to you, will be identified with this particular 14-digit PayPal ID only. So apart from those normal PayPal IDs or normal transactions or normal supplier customers PayPal ID, this is 3 unique IDs which has been identified again, which is mandatory. So any transaction where you're doing under deemed supply, so this is the fixed ID which you are going to highlight, or which you are going to define in your tax, in your accounting softwares and ERPs. Then there is something called issuing tax invoices to buyers, not yet issuing e-invoicing under the rollout plan. That means all those customers, all those taxpayers who are going to go live from 1st of January 27, but it could be possible that your customers or your suppliers are still not a part of phase 1 and they're part of phase 2. So till that moment, you have to keep using this PayPal ID, through which tax authorities will come to know that your customers are not in the rollout plan 1 or phase 1. The moment phase 2 is implemented, majority or most of everyone will be a part of this rollout. And that's the reason then everyone will have a unique IDs. Number 3 is a unique ID used for exports. Let's understand specific scenarios and the challenges which we have identified during our gap assessments. Let's see. So investment holding companies are typically a legal structure, right? So investment holding company earn passive incomes like dividends and interest. So if the revenue is only passive income and no business transactions occurs, then they are not a part of e-invoicing, or they don't have to follow e-invoicing. But let's say same company, a holding company earning something, a technical fees, management fees, or any third party recharges, then this holding companies will also be a part of e-invoice. Another one relief, which is recently given, every company or every group of companies having a part of same tax group. When I say tax group, that means tax VAT group and not a tax corporate tax group. Okay. So let's say a group of companies part of the same VAT group is excluded from e-invoicing. That means, let's say Fame Advisory has Fame Advisory 1 and 2 companies, both part of the same group. Then any transaction between these two companies who is in the same VAT group is excluded from e-invoicing only for the first 24 months. That means from 1st January 29, they have to again comply under e-invoicing rules, and they have to, whenever they start raising invoicing internally between the group companies, VAT group companies, that will be also part of e-invoicing. They have to go through e-invoicing. All right, let's understand few examples. Advance payments. In case where the business receives an advance payment, a tax invoice must be issued at the time of receipt. Okay, that means, therefore, when issuing the final invoice, it should cover only remaining balance. And there are steps. So basically, what we are trying to explain here is there are certain transactions which we do it in our day-to-day life. That, let's say, if we are raising a tax invoice or we are raising a commercial invoice, that means if we are doing a taxable sales or we are doing a, let's say, port-to-port high sea sales. In both cases, if we receive advance payments, you have to go through under e-invoicing. We cannot just say that, no, we have received this invoice or advance payments only. The actual supply of goods has not happened. That's why we will not either, or we will not follow e-invoicing. Right? So deemed supply, free of charge. So what will fall under, majority what will fall under deemed supplies, free of charge supplies, gifts above thresholds, private use of business assets or inventories. So these are the few examples again. So what we are saying is VAT registered persons supply treated as a taxable supply should treat this as a taxable supply, and they have to follow e-invoicing. Now, if you see in the key considerations, it says buyer's electronic address must always be this, which we have already shown before. No e-invoicing exchange if recipient does not receive an invoice. Only supplier's ASP reports to the FTA. Even margin scheme, which is a profit margin scheme, where it is applicable to the used car dealers or gallery selling artwork. Sorry, bought from private collectors. There also, VAT is calculated only on the profit margin, which is selling price minus purchase prices. And as per VAT law, and Pint A requires a VAT info, but VAT amount is not required under this, so that's why e-invoicing still applicable, but the amount displayed will be 0. Continuous supply, building material installments and milestones, which I think a lot of people will be aware that this, continuous supplies will be which is a part of a regular supply provided continuously, periodically with recurring milestone-based billings. So again, retention must be shown in a separate commercial document, not on the e-invoicing, and then issue an electronic invoice with VAT once retained payment becomes due. As we have compulsion on the data storage and data scanning or data storage in under VAT and corporate tax, same way there is a data storage requirement under e-invoicing as well. So you need to retain or store data for 5 years following the tax period to which they relate in respect of a taxable person. 5 years from the end of the calendar year in which the consent document was created in respect of all persons other than taxable persons. 7 years from the end of calendar year in which the consent document was created for real estate records. So these 3 important points. In addition, taxable person must retain record for 4 more years in case there is an FTA audits or FTA disputes. Now, how it is going to impact your businesses. So we have divided that into 5 steps. Check the applicability for e-invoicing, whether it is applicable to you or not, or you have exclusions. Step number 2, check implementation date based on revenue. That means, are you falling under phase 1 or phase 2? Third, impact assessment, where FAME can help you to identify all the gaps, looking at your trial balance, understanding from your accounts, receivables department, payables department, and identify such scenarios where currently you are doing a wrong tax treatments, where currently you are not considering dim supplies. Currently, you might not be considering you might be taking some wrong stance on the tax side. All those we identify and help you to give you the right tax treatment, so that the moment you go live to each and every documents which is going to be seen by the tax authority from day 1, you don't end up giving the wrong informations to the tax authorities, which ultimately comes back and you might get a tax audit, right? Then we also help you in appointment the right ASP. And if you are using a different ERP systems, we help you to appoint a right ASP, and then we help you to even do a trial run. We train your teams, right? And help them to do a trial run, so that when you go live, we don't end up doing mistakes, doing any kind of errors at time of invoicing when we go live. Because if we make errors, obviously we are in UAE and we will get penalties for sure. So penalties list is in front of you. Failure to implement or appoint an ASP will be 5,000 dirhams per month penalty. Failure to issue or transmit e-invoice, it will be 100 dirhams a day, 100 dirhams per document, which can go up to maximum 5,000 dirhams a month. Failure to transmit e-credit notes, that also gives you a penalty of 100 dirhams per document, which can go up to 5,000 a month. Failure to notify tax authorities of a system failure. Let's say for any reason, if your ERP is not working, for any reason, you have to inform or notify tax authority within 48 hours. If you miss doing that, 1,000 dirhams per day is your penalties. Failure to notify tax authority on any ASP change. Today, out of this 42 ASPs, you have selected, let's say, any one ASP. Tomorrow, if you're not comfortable working with those ASPs, in the backend, you have changed the ASP, but if you fail to inform tax authority or appoint or reappoint ASP on the MRA tax portal, then 1,000 per day is your penalties. So not taking more time, I would be open for the questions once Junaid completes her his transfer pricing discussion. Please feel free to check. Junaid, over to you, please.
Yeah, hi, very good morning to all of you. Thank you, Udit, for sharing a detailed insight on e-invoicing and a very warm welcome to all of the participation. It's great to see that there are more than 180 participants, those who are participate in this webinar. This shows that this topic of not only e-invoicing but also the transfer pricing require utmost important in this present scenario. With the scene that we have, the compliances in the UAE has been increasing, so it require utmost important for the businesses to pay an attention with the overall development that has been taking place. And also we would like to be very thankful to thank you to Russell Kema Free Zone Authority to give us an opportunity to speak on an important topic of both the e-invoicing and the transfer pricing. So without wasting much more time, now I'll start on the topic of transfer pricing. Now the corporate tax law has been introduced from last 2 years, and last year also we had filed the return. So not only the last year, but also right now also during the second season of return filing, what we have been facing, and we are getting an inquiry or query from the businesses that what is transfer pricing, is it applicable even to the small company, and whether it require every year benchmarking or a financial update. So with this and with this webinar, we will help to sort it out all of the queries that were raised or that are presently surrounding within this community or within UAE with the help of this webinar. So first I'll start with the basic. Basically, what is transfer pricing? In particularly, before jumping onto the what are the UAE compliance and the regulation in particular for the transfer pricing. Basically, transfer pricing concept arise when there are two related party transactions, and this transaction might be either within the same jurisdiction or within a different jurisdiction. So to benchmark or to identify whether the transaction that between the two related party that is undertaken, whether there was any need to undertake such transaction, if yes, what was the benefit that has been arise or it has been getted or it has been get by the recipient entity, and at what price such whether this transaction has been settled. So a benchmarking is basically required. Basically, when we talk about transfer pricing, people get confused. They consider benchmarking and the arm length price and transfer pricing as one and the same. So basically, this is a wrong concept. All of this concept are a part of transfer pricing, but each one, the benchmarking and the arm length principle or the pricing, are a different concept. So we will break out and we will simplify each of these concepts in my upcoming slide also. Now we will discuss what is transfer pricing. Transfer pricing, as I have said, it's a pricing that has to be determined taking into consideration that if such transaction were taken place with a third party, then at what price such transaction was taken place. And the similar pricing we have to apply in our related party transaction as well. What are the key objectives? The primary objective is that shifting of the profit from high tax jurisdiction to low tax jurisdiction. So let's say in case if a country where there is very high tax rate, so there might be a related party transaction where where an expense has been overbooked in one tax jurisdiction where there is higher tax rate, to claim the expense as at a deductible, to claim that expense as a deductible in a country where there is a high tax rate. So this prevents shifting of profit, and thereby it helps to evade the taxation and thereby applying an arm's length principle. And it also ensures that the prices or that the income has been fairly allocated between the two parties. And it also helps to maintain the parity between the independent transaction. Now we will come on to the slide of the arm's length principle. What is arm's length principle and what is this arm's length price, and where we have to apply this arm's length pricing. So arm's length pricing we have to apply between the two related party and between the connected person. So all the transactions that take place between the related party or between the connected party has to apply the arm's length principle. And this signifies that the transaction or the price that we apply should be similar to the price that has been charged to the third party as well. Now, with the help of an example, we can get an understanding that what is arm's length price and how it is important, and within UAE also, what role does the transfer pricing play. Let's take an example wherein an entity in UAE has made a sale of goods to its related party in another tax jurisdiction. Let's assume BVI. In UAE particularly, I'll take a normal example where it's a mainland entity which is subject to tax at 9%. So it has made a sale of 1000 USD to its related party, and after incurring the cost of goods sold and indirect expenses, it come up with a resultant profit of 200 USD. On this 200 USD, it is subject to tax, let's assume at 9%, so it pays the tax of $18 in a normal scenario. Now, being a related party transaction, such sale transaction to the BVI entity require a benchmarking, or we need to justify this $1000 whether this transaction is at arm's length price or not. But after undertaking the benchmarking analysis, it comes to the conclusion that the arm's length price for the sale transaction is 1500 USD. So with the increase in the sale price from 1000 to 1500, our profit of UAE entity will increase by 500 USD. So with the increase in the profit, the resultant tax liability will get impacted, and it will also get increased. So that's why transfer pricing play an important role, not only to justify the transaction, but also to determine and also to determine the fair price or the exact price or the arm's length price. So it just not only apply on the income part of the transaction, but it also apply on the expense as well as on the loan transaction, which will have an impact on the profitability as well as on the tax liability. So after undertaking a benchmarking analysis, it come to the conclusion that the transaction was not at arm's length, and hence it require an upward adjustment or a correction by way of credit note or a debit note in the books of account. Similarly, I'll go on to the another example. Instead of income, now it come to the expense part. So when it come to the expense part, let's assume the same two party, one party is in UAE and another party is outside the UAE. So UAE entity, in order to reduce its tax liability, it has increased its expenses, which is not at arm's length. For example, it has availed a management service from its related party, and the arm's length price for the management fees, what's assumed at an under arm's length case was 100 USD, but instead of recording at arm's length price of 100 USD, it has considered the indirect expense of management fees at 200. It has overbooked the expenses by $100 USD. So by increasing the expenses by 100 USD, it tried to reduce its profit. So with the reduction in profit, it tried to reduce the tax liability. So which again the transfer pricing play an important role to justify and to reconsider the pricing or the transaction that has been entered between the related party. So with the help of transfer pricing benchmarking and the help of transfer pricing, the profit will increase by way of an either upward adjustment or by getting a debit note from the related or from the concerned party. Now the basic concept of transfer pricing we have clear. Now we'll move on to the next topic of what are the transfer pricing regulations that is applicable in UAE, and what are the provisions that every taxable person, those who are undertaking the related party transaction, whether it would be a free zone, it be a mainland, or an entity which is who is claiming small business relief. So even an entity whose turnover is very less or its turnover is below 3 million dirham also, then to also it become mandatory for them to comply with the transfer pricing regulation. So even a single dirham transaction require a benchmarking exercise to be performed or a transfer pricing compliance to be performed within UAE. So I said there is no exception for any entity of those who are undertaking related party transaction. So when it particularly come to UAE, there are four articles which is govern the transfer pricing regulation. One is Article 34, which talk about what is transfer pricing principle and how does it apply and to whom does it apply. Second comes Article 35, which define the meaning of related party and define the meaning of control. Article 36 states what are connected person, who are connected person, and which transaction would be covered under Article 36. And the last article that govern is Article 55, which mandate that the transfer pricing documentation is required to be maintained, and what kind of document that are required to be maintained depending upon the threshold limit that we will discuss in the upcoming slides. Now we'll move on to Article 34, which state about arm's length principle. So arm's length principle, as we have discussed also, it's a principle or it's a price that one entity has to charge to its another related party that it has to charge to its another related party the same price if it charge or if it undertake a transaction with the third party. So let's assume there are two company A and B. So if there is any transaction of either sale, purchase, or any provision of good, then such transaction has to take place at arm's length price. So arm's length principle, so as I have discussed also, so under transfer pricing, there is a confusion between the businesses also, that benchmarking, transfer pricing, and arm's length. All they consider as one and the same. And even there is a confusion that is going on that local file and benchmarking report are one and the same. So no, all are different, but all are a part of the transfer pricing rule and the compliances. So benchmarking is just an exercise which need to be undertaken to determine the arm's length price. But benchmarking itself, study itself will not help to justify whether the transaction was at arm's length or not. So that's why arm's length is a different concept as compared to benchmark. Benchmarking will help us, it's a process that helps us to determine the price, but the related party transaction must comply with the arm's length principle. So in a simple term, if to put in, arm's length principle is an objective to determine or to state whether the transaction was required based on the need benefit analysis that we have to undertake, while the benchmarking study is a method to verify that the objective has been properly achieved or not. So arm's length principle or price is a standard, whereas a benchmarking is an evidence, is a proof. So it doesn't mean if any wrong transaction or if any transaction that has been undertaken to avoid or to reduce the tax liability, and in such a manner if an entity has undertaken a benchmarking analysis that will safeguard him. No, it's not entirely correct. So benchmarking study or a transfer pricing report is just a document proof which state that the transaction is at arm's length, but it will never state that the transaction was correct or wrong. Now we will move on to the next article of Article 35, which define the related party transaction, or what are related party. So related party are defined by way of three parameter. From the basis of three factor, it can come, or we can define whether a party or a person is a related party or not. If there are two or more individuals, those who are related till the fourth degree of kinship or affiliation, then those person would be considered as a related party. In the second leg of the related party definition, it covers individual, those who are related to a legal person. For example, if there is a company and that company is being owned by a shareholder, if the ownership is directly or indirectly exceed 50% in a share capital of a company, then that individual would be considered as a related party for the legal person. So with the help of an example also, we will cover those who are individual and those who are legal person that are considered as a related party. And the third leg of related party definition cover where there are two or more legal entity, but they are also considered as a related party. And that can be established by way of if one legal entity together with another related party control directly, own directly or indirectly 50% or more of the share in another entity. And also it covers the branches and the permanent establishment. So even if an HO who is having a branches outside the UAE or within the UAE, then too also they are covered or they are considered as a related party. And also if there are two or more partners in an unincorporated partnership firm, then they are also considered as a related party. So transfer price and trustee, founder, settler or beneficiary of the foundation would also be considered as a related party. So the transfer pricing exercise or the transfer pricing compliance, first of all, it requires an identification of a related party, whether the parties involved in the transaction are related party or not. If the question is yes, then the further compliances and the exercise would require or would come into place. Now, if we have discussed that if there are two or more individuals, those who are related till the fourth degree of kinship, so these are the individuals that are covered from first degree of relative or kinship till fourth degree of kinship. So it cover parent, great parent, great grandparent, great great grandparent. So till the extent of fourth degree of relative, it is covered and it is considered as a related party. So related party, as we have discussed, it is governed or it is been determined by way of ownership and also by way of control. So ownership is a document that can be apparently seen by way of either share certificate or the trade license or from the company incorporation document that yes, they are the owner uh, of a legal company and hence they are considered as a related party. But when it comes to the control, to establish whether a control is there to identify whether the transaction or the party is a related party or not, it requires utmost due diligence and a further documentation is also required because control cannot be easily documented or it cannot be easily seen from the document. So there are various check facts from which we can identify that yes, control was there and hence they are considered as a related party, such as if there is a voting right power that has been given to any individual of more than 50%, or if any individual who is entitled to the profit of more than 50%, or if there is a composition of the board of director which comprises more than 50%, or if there is any significant influence of any one legal person or of any one individual person over the legal entity. If he has a significant influence, those who take into strategic decision of the company, then that person would be considered as having control irrespective of the fact whether he own any percentage of the share capital of the company or not. So by way of definition of a control, if he has a significant influence, that person would be considered as a related party. So with the help of an example, we will see to it that which are those parties that are considered as a related party. For example, there are three shareholders, there are three partners in an unincorporated partnership firm. So all of this partner in a partnership firm would be considered as a related party. And hence, any transaction between this partner and the partnership firm would require a transfer pricing analysis and a compliance need to be performed. So as I have said, ownership can be easily documented or it can be easily seen by way of a corporate document. But when it comes to the controlling part, it becomes difficult. It require a detailed analysis also. So with the help of this example, we will see to it whether there is whether this two-party company A and B are considered as related party by way of either ownership or by way of control. There is a transaction between A and B. Company A provide a software license to company B for in consideration for which it get royalty 50% of the profit for the sale that has been made by US company. So company A and B that has signed a royalty agreement in which company A is entitled to 50% of the profit that has been generated by company B from the use of the software. So as we have seen that the control can also be established in case if any of the party has an entitlement to a profit of another party to the extent or minimum 50%. So in this case, company A is getting 50% of the profit from company B, irrespective of the fact whether the company A is not owning company B or company B is owned by any other shareholder, then two of the company A and B would be considered as a related party by way of control. Similarly, there is another example wherein a strategic function has been performed by UAE company, which is company X. It provides development of strategic function and formulation of key marketing. All of the key functions are being taken by company X in UAE for company Y, which is in UK. Company Y is being owned by another shareholder, which is not owned by company X. So not by way of ownership, but by way of control, company X and company Y both would be treated or would be regarded as a related party through the definition of control. Now we will move on to the next article which deal about or which define the connected person or which state who are the connected person. So connected person are divided in threefold. One is the owner of the company who has direct or indirect control over the legal entity. Second is the directorship, Directorship can either be a director or the officer of the company or of the legal company, irrespective of the fact whether they are not the owner of the company. Then too also, if they are director and if they perform strategic role, depending upon their roles and responsibility, they would be considered as a connected person. And lastly would be the partner. Owner, it's simply under, we can simply understand that they are the owner of the company and hence they are considered as a connected person. But when it comes to the directorship, director or the ward officer has not been defined in the law. So simply going with the legal designation or the title of director or officer does not constitute any person to be a connected person, for which a public clarification has also been issued by an FTA, which we will discuss at a later stage, that not only going to the legal title or the designation of director or officer, they would be considered as a connected person, but they should perform certain roles, responsibility, or they should influence the board. Then only they would be considered as a connected person for the purpose of transfer pricing rule. So let's take an example wherein Mr. B, who is an owner of company D. So as he is an owner of company D, Mr. B would be considered as a connected person for the purpose of transfer pricing regulation. And also over here, if there are partner in a unincorporated partnership firm, all of the partner would be considered as a connected person. So over here also, if Mr. A is a director of company C, he shall be regarded as a connected person of company C. But as I have discussed, we have to see the roles, responsibility, time, effort, and what strategic decision he has taken into the company, what was his role, responsibility, then only we would be considered this Mr. A as a connected person. So simply by way of the title, we cannot consider it as a connected person. So when the payment has been made to the connected person, so what payment that are covered? So any payment plus the benefit that has been made to the connected person will have to be correspond to the market value. So arm's length principle or the testing would be required to justify that the payment made to the individual is at arm's length. Because when it comes to the UAE particularly, or even in the Middle East also, there is no personal tax on an individual. So and hence it becomes difficult to benchmark any of the transactions that has been undertaken with the connected person, as individual are not subject to corporate tax. So company can take the advantage of booking higher expense or claim higher expense in the nature of director remuneration or any payment that it made to the individual. So that's why it become utmost important for the company to benchmark the transaction that it has undertaken with the related party. So only if the expenses that has been incurred wholly and exclusively for the purpose of taxpayer business only, then it would be considered as a payment made to the connected person. So for example, if the company has made a payment to the owner, if we consider that payment as a payment made to the connected person and booked it as an expense, so it would not be easy for the company to claim that expense as a deductible expenditure. For example, if any personal expense has been incurred by the company for which the payment has been made on behalf of the individual, then that payment, if as it is not related to the business fault of the company, it would not be considered simply as payment made to the connected person. So even if we undertake the benchmarking exercise, it will not help. It such expense would be entirely disallowed as it is not related to business activity of the company. So here, based on the past experience and the return that we have filed for the last year, and even what we have seen from couple of companies, these are the common related party transactions that has been undertaken between the related parties, such as sale and purchase of the goods, management fees, manufacturing of the goods, intra-group services, sale and purchase of tangible asset, director remuneration, any provision of salary or intra-group payment, intercompany loan. All such transactions between the related party require benchmarking along with the help of the not only the benchmarking but a proper supporting and a documentation is also required. So before going on to the benchmarking, it require a proper documentation for all of such related party transaction. So simply benchmarking will not provide you a solution, or it will not help you to justify that the expense that you have claimed or the purchase that you have undertaken is correct or wrong. But there has to be a proper documentation for all of this related party transaction. Now we'll move on to the next topic, wherein first we have identified who are the related party. Based on the related party, we have to now apply the Article 34, which state that the transaction has to be at arm's length price. So to determine whether a transaction is at arm's length price or not, there are various transfer pricing method which has been governed or which has been provided by OECD, and also the same method has been adopted by the UAE. So there are multiple methods for which we have to determine the transaction, whether it is at arm's length or not. So first method is comparable uncontrolled price, that is commonly known as cup method, and it's widely used acceptable method also, where there are comparable companies so as to determine and so as to use this cup method. Second method is the resale price method. Third is the cost plus method. Fourth is also an important method which is known as transitional net margin method. Fifth is the profit split method. Last is the other method. In case if any of the company, while performing the benchmarking exercise, if they fail to get any of the result from any of this method, then the last option would be the other method. So based on the practical input and the documentation, it would be governed by the other method. Now we'll see to it how this method apply and what are the, with the help of an example, I'll help you out. Comparable uncontrolled method. This method is applicable, or this method can be used where a similar product is being sold by company, for example, one entity within the group. For example, when let's take an example of coal. If entity A is dealing coal activity, and if it sell the coal to the related party as well as to the unrelated party as well. So then instead of going on for the full-fledged benchmarking of external comparable, it can use the internal comparable also, wherein it can justify or it can compare. Or if they want to prove that the sale of coal to the related parties at arm's length or not. So as to determine whether the transaction with the related parties at arm's length or not, the company will make a comparison of the transaction of such coal that it has made a sale to the independent party or independent third party. So cup method require a high degree of comparability. So cup method cannot be directly used. It can only be used where the product are of similar nature. Then only it is advisable to use, or then only it can be used as an acceptable method. So there are two methods under the cup also. One is the internal cup and the second one is the external cup. In case of an internal cup, let's assume an example. A manufacturer A sold the goods to both the party. Both the party means one to the related party and one to the unrelated party. If the sale of a similar product that it made to the unrelated party is 1000 dirham, but if the sale of same coal product, for example, or a similar product, it's sold to the related party at 800 dirham, as this transaction is not at arm's length for sale made to the related party, then an adjustment is required in the books of manufacturer A to bring the transaction of 800 that it had made with related party to 1000 by either way of raising the debit note of 200 or making a TP upward adjustment. And hence the arm's length price has to be 1000. So upward adjustment in the books would be required to bring 800 to 1000 dirham. This is possible only in case of a similar product and in case where a company is selling a similar product to the third party as well. An external cup method can be used where a company find it difficult to see whether the similar product was sold to unrelated party within the same group or not, or within the same entity or not. So then it can rely on the external method where it will see if the similar product is being sold in an outside market by the third party businesses to the customer, what would be the price. So in case if any sale has been made by any other manufacturer to any other unrelated party in an open market price. So what is the open market price? So that it will use as a comparable to determine whether the transaction with the related party is at arm's length or what pricing it should charge. So this cup is very commonly used acceptable method under transfer pricing. Similarly, there is another resale price method. It's a traditional method where it will compare the gross margin of the two of the related and unrelated party transaction. And also there is a cost plus method. Cost plus method require an appropriate markup to be charged. So in this example, if you will see, there is a cost that has been incurred by a company of 50,000 on raw material, labor 15, indirect expenses of 15,000, which total up to bring a cost of production of 80,000. So on this 80,000, if it want to sell this product to its related party, then what should be the markup it should add? So it require, based on the appropriate benchmarking that we undertake, let's assume 25% is a markup based on the benchmarking study that we have undertaken. 25% is the markup that is required to be added. Then on 80,000 cost, a markup of 25% is required to be added, so as to consider the transaction at arm's length. Similarly, there is a profit split method also. Based on the profit that is being arrived jointly, it will get split between the two related party. So here is an example of detailed example which we can see that a profit of, for example, of company is making of 10 by company Y. So it required to be split between both the related party, between company X and between Y. So based on the benchmarking exercise that a company undertake, it has to split this profit of 10 into two component into two companies, so that the profit get allocated between the two taxable entity, and the right share of profit has to be allocated between the two entities. Transactional net margin method, which is commonly used and commonly known as TNM method also. What does this method do? This method compare the operational profit of an entity with a comparable company of the competitor. So this is widely used method in case where it is not easy to compare or to use the other method of cup resale method or profit selling method. So under TNM, an arm's length price is determined based on the profit that the company is deriving. So with the help of an example, we can see to it how this TNM method can be applied or it can be used. Let's assume an example of a company where a company is making a sale to its related party. It has made a purchase also, and after incurring all of the cost and expenses, it come up with a profit, or you can say it's an operating profit of a company of 100 dirham. So on the sale of, on the revenue of 5,000, it has earned an operational profit of 100 dirhams only. So this 100, if we'll divide by 5,000, it gives a profit margin or operational profit of the company at 2% only. Now this 2% we have to compare by way of undertaking a detailed benchmarking exercise. So let's assume a benchmarking comparable result would provide that a company should have a profit margin of 10%. Then in this case, the profit that the company at present has derived, which is 2%, will be considered as not at arm's length price. So it require an upward adjustment in its book from 2 to 8, from 2 to 10%, with a differential of 8% markup to be added. Similarly, there are other methods also. If we fail to consider any of the method, then the other method will come into picture. For example, if the company is charging or want to recover a rental income on the property, so then a valuation report would be required, which can be justified, which can be used. Or in case of any sale of scrap that has been undertaken, then the valuation report can be used, or a third party quotation can be used. Now we'll move on to the next part, is the compliance part within the UA with regard to the transfer pricing. Transfer pricing require a compliance in a form of TP documentation. There are two documentation that is required. One is a local file and another one is a master file. So depending upon the threshold limit of the company, this file is required to be maintained. And even transfer pricing disclosure form is required to be maintained in case where there is an aggregate value of related party transaction in UAE if it exceeds 40 million dirham, and aggregate value of per transaction within the per category of related party if it exceeds 4 million dirham. So TP disclosure form is not a separate disclosure form. It's a part and parcel of the corporate tax return filing only. So while filing the corporate tax return, if the threshold limit has been breached, then a detailed transaction wise information need to be provided while filing the CT return. So these are the threshold limit only for the purpose of disclosure. So this limit is only for the purpose of disclosure. So irrespective of this limit, if there is even a 1 dirham transaction between the related party, still the arm's length compliance is required. And local file, when it comes to the local file and master file, it required to be prepared and maintained only in case if the standalone revenue of the UAE based entity exceed 200 million dirham in a year, and the group is also a part of MNE, and the group having a consolidated revenue of 3.15 billion dirham. So this local file and master file are not required to be submit at present, because as and when if the FTA request, then within 30 days it has to be submitted. But while submitting the corporate tax return, it is not required to be submit, but it need to be prepared and maintained at the time of filing the return. Similarly, there is CBCR, country by country reporting. It need to be filed or it need to be submitted by a UAE headquarter M&E group if they have having a consolidated revenue of more than 3.15 billion dirham in the immediately preceding year. So these are the disclosure form or the format. So these are the disclosures that we are required to submit at the time of CT return filing. And also there has been a recent clarification that has been issued by an FTA when it comes to the definition of connected person. So as I've said in the earlier slide also that the definition of director is that's not been defined, but not going to the legal term or designation of director. It has to be seen that whether they are actively involved and what role and responsibility that they are performing. So only a natural person can be a director and the officer of a taxable person. Further, FTA has come up with a recent clarification and by way of private clarification. It states that even for the qualifying free zone entity, it's mandatory for them to comply with the arm's length principle. Now they have given a clarity that even if the free zone qualifying free zone person want to make an upward adjustment for the transaction with the related party, then such upward adjustment or such TP adjustment would also be deemed to be considered that they comply with the arm's length principle or the transfer pricing provision, and hence it will not affect the qualifying free zone status. With recently last week also it has come up with a downward adjustment notification wherein it has stated that even if the downward adjustment in a sense, if it want to reduce its profitability, it can reduce by way of making a downward adjustment, but such downward adjustment would require a TP disclosure irrespective of the fact whether the threshold limit of 40 million or 4 million has not been breached. Then too also a detail would be required in case if the entity or a taxable person wish to go for a downward adjustment. So there are further slides that covers the real-time cases for the related party transition, but due to shortage of time, I would prefer one thing. We would be sharing this slide wherein you can you can go through this transaction which require an importance, or we have to be mindful what are the documents that are required in case of a related party transaction. So still there are common myth between whether benchmarking is required every year, whether financial update is required, what is financial update. So everything we have covered in the presentation, but I think so because of shortage of time, I would be running on this slide that whether what are the things that are commonly asked question. So we have covered all of the questions that has been covered or that has been repeatedly asked by the community or by the taxable person. And also lastly, I would like to conclude that transfer pricing is not just a year-end exercise. Similar to e-invoicing, which is coming into place next year, this transfer pricing is also not a year-end exercise. With e-invoicing, it also becomes important for a taxable person because e-invoicing will act or will play as an evidence for the transfer pricing documentation as well. So any transaction that taken place or that will take place in the era of e-invoicing would be considered as a benchmark document, and that would be considered on record, and that pricing would be determined or would be considered for the purpose of even transfer pricing also. So one cannot escape and can make a year-end adjustment. With the e-invoicing era, the transfer pricing will also play an important role at that time. With this, I would like to complete my session on transfer pricing. For any query or anything, you can email us or you can contact us also.
Thank you, Junaid, for the session as well as Udit. Thank you. I know it's a vast topic and
Yes,
really needs a lot of time and focus for people to understand in detail. But yes, we have a shortage of time because I think everyone will have their other
yes,
priorities to be taken care after this. For the people, so there are questions, but I think most of them are answered on the Q&A tab itself. So I don't think we need to go for any further questions here. But for the people who have been asking regarding the copy of slides as well as the recording. Yes, we will be sharing both these information. So even the slides which will be shared with you will have the contact details for Junaid and Udit. If anyone wants to reach out to them regarding any query to get more detailed insight, they will be there to assist you. In case if you wish, you can directly contact us, RAC ICC, and we can also assist you in terms of getting in touch with them or getting the details from them so that we can assist you further. So I think it was a great session. Thank you so much, Udit. Thank you so much, Junaid, for your time. Thank you, audience, as well, for your time. I know it's gone about 1 hour, but I think it was a very good session to for people to understand how taxes work in UAE.
Yeah.
Thank you, everyone.
Thank you
So
very
in
much,
case if
Donald.
you have any query, you can reach out to us.
Thank you, everyone.
Thank you.
Thank you.